in 2014 to 3.5% in 2015, although with considerable variation across regions and major economies. The softening oil prices have continued to support an uptick in growth of oil-importing countries, but dampening growth prospects in major oil exporting countries. Overall, economic activities have gained some traction, particularly in the United States and the United Kingdom, underpinned by sustained monetary easing, ebbing fiscal consolidation, improvements in housing market conditions, lower financing costs, rising private consumption, and increase in real household income. Elsewhere, low commodity prices continued to boost higher aggregate demand, in addition to creating conditions for accommodative monetary policy, especially in Japan and the euro area, where recovery appears to suffer severe setbacks due to structural bottlenecks and the threat of deflation. For the Eurozone, however, the massive quantitative program of the European Central Bank opens a new growth vista, halting the slide potential output and engendering a more solid recovery. Global growth is expected to accelerate to 3.8% in 2016, but with significant downside risks. Protracted stagnation in the euro area could constrain global trade, while the anticipated end of monetary easing in key industrial countries could limit investment growth. In addition, stronger currencies in both the United States and the UK may likely moderate net exports, coupled with lower capital expenditure in the energy sector due to the softening oil prices. Furthermore, the huge assets purchase program by the United Kingdom Treasury and the Bank of Japan is an indication of divergent monetary policy stance among key advanced economies, with the attendant widening of long-term interest rate differentials. We are of the view that with the UK inflation at minus 0.1% in April, the size of its assets purchase program of £385 billion may be revisited by the Treasury. For many emerging markets, the outlook for growth is less optimistic, reflecting cyclical factors, domestic policy tightening, political tension, and structural factors. In China, growth is expected to decline below the long-run target of 7% in 2015, owing to financial market vulnerabilities, decline in productivity, excess capacity, and weakening domestic demand. It is, however, envisaged that recent policy stimuli by both government and the People's Bank of China would help unwind the excess capacity and strengthen the financial system, with ultimate goal of restoring growth to the historical path in the long run. Developing economies as a group continue to show relative resilience, with growth projected to accelerate from 4.4% in 2014 to 4.8% in 2015. Growth in the developing economies is also expected to remain uneven in the near term, reflecting the pattern in the advanced economies. Countries with high trade exposure to the United States and the UK would likely gain substantial momentum, while those depending on the euro area may experience continuing slowdown in export demand in the near to medium term. Key risks to growth in the developing economies include the possible tightness in the global financial markets and the diverging stance of monetary policy in the advanced economies, which portend great consequences for capital flows, exchange rate stability, and inflation expectation. In addition, sudden deterioration in liquidity conditions, volatility in commodity and financial markets, narrowing fiscal space, and rising geopolitical tensions are headwinds that could constrain global output growth. Thus, monetary policy in a number of developing countries has to contend with the delicate choice among supporting growth, reining in inflation, and stabilizing currencies and the financial systems. Global inflation remains benign and is expected to be moderate in 2015 to 2016 due to the tailwinds from the sharp drop in the prices of crude oil, excess capacity, and appreciation of currencies in key advanced economies. The deceleration in growth, which commenced in the third quarter of 2014, intensified in the first quarter of 2015 in the aftermath of declining crude prices. The National Bureau of Statistics estimated real gross domestic product at 3.96% in the first quarter of 2015, which is significantly lower than the 5.44 and 6.21% during the preceding quarter and the corresponding period of 2014, respectively. Real GDP growth is projected to decline to 5.54% in 2015 from 6.22% in 2014. In line with trend, the non-oil sector remained the main driver of growth in the first quarter of 2015, recording 5.5%. The key growth drivers in the non-oil sector during the period were services, trade, agriculture, which contributed 2.8%, 1.27, and 1.05 percentage points respectively. The modest improvements recorded in the oil sector in the fourth quarter of 2014 appear to have been reversed as oil GDP contracted by 8.15% in the first quarter of 2015 compared with an increase of 1.2% in the preceding quarter. Committee expressed concern about the weakening economic momentum but recognized the relative similarity in the condition to the evolving economic environment in virtually all oil exporting economies, suggesting the need for acceleration of various ongoing initiatives to diversify the economic base of the country. With the successful completion of the 2015 general election and the progress recorded so far in the fight against insurgency, the committee was optimistic that slow pace of economic momentum would reverse in the near term. Committee noted that the year-on-year headline inflation crept upwards from fourth consecutive month in April 2015. The inflation rate rose from 8.2% in January 2015 to 8.5% in March and further to 8.7% in April of 2015. The increase in headline inflation in April reflected increases in both the core and food components. Core inflation rose to 7.7% in April from 7.5% in March, while food inflation increased to 9.5% from 9.4% over the same period. The committee noted that the uptick in inflationary pressures year to date was largely traceable to transient factors such as high demand for transportation, food and energy, especially in the period around the general elections, as well as the Easter festivities. It also noted the roles played by system liquidity and the pass-through effects of the recent depreciation of the Naira exchange rate. While the transient causes are isolated, the committee observed the decline in month-on-month inflation across all the measures in April as headline inflation moderated to 0.8% from 0.9% in March, core inflation moderated to 0.6% from 0.8%, and food inflation moderated to 0.9% from 1%. Committee reiterated its commitment to price stability, noting that given the already tight stance of monetary policy and the transient nature of the incubators of current inflationary trend, which are outside the direct control of monetary policy, the space for maneuver remains constrained, necessitating the intervention of fiscal and structural policies to stimulate output growth. Broad money supply increased by 1.8% in April 2015 over the level at end of December of 2014. When analyzed, M2 increased by 5.39%, which is lower than the growth benchmark of 15.24% for 2015. The modest increase in money supply reflected the growth in the net domestic credit of 9.66%. Annualized net domestic credit grew by 28.98% over the end of December 2014 level, which was within the provisional benchmark of 29.3% for 2015. The significant growth in aggregate credit was traced mainly to federal government borrowing, which increased by 177.26% in April 2015, or 531.78% on an annualized basis. In the period under review, money market interest rates were relatively volatile, reflecting the fluctuations in the liquidity in the banking system. Average interbank call and open buyback rates, which opened at 11.92 and 10.75% on 2nd of March 2015, closed at 15% and 13.26% respectively on April 17, 2015. Average interbank call and open buyback rates for the period were 19.02 and 17.45% respectively. Committee noted a modest improvement in the equities segment of the capital market during the review period. The all-share index rose by 9.3% from 31,744.82 on March 31, 2015 to 34,708.11 on April 30th. Similarly, market capitalization increased by 10% from 10.72 trillion to 11.79 trillion in the same period. However, relative to end of December of 2014, the indices increased marginally by 0.1 and 2.7% respectively. The recovery in share prices, particularly in April 2015, was largely due to improvements in earnings and sentiments amidst successful conclusion of the 2015 general elections. External sector development. The average Naira exchange rate was relatively stable at both the interbank and bureau de change market during the period under review. The exchange rate at the interbank market opened at 197.8 Naira to the dollar and closed at 197 Naira to the dollar, with a daily average of 197 Naira 4 kobo to the dollar. This represented an appreciation of 80 kobo for the period. At the bureau de change segment, exchange rate opened at 225 Naira to the dollar and closed at 217.5 Naira to the dollar, with a daily average of 216.75 Naira to the dollar. This represented an appreciation of 7 Naira 50 kobo for the period. The stability and modest appreciation in the two markets was largely due to the closure of the official Dutch auction system market and the modified two-way quote trading at the interbank segment of the market. Gross official reserves rose from $29.34 billion at the end of March 2015 to $30.05 billion on May 15, 2015. The committee's consideration. Committee noted the salutary effects of successful conduct of the 2015 general elections on the macroeconomic environment. The committee expressed optimism that confidence and goodwill arising from the successful elections would stem the spate of capital reversals, reduce pressure in the foreign exchange market, and stabilize the financial markets in the short to medium term. A combination of the renewed confidence and recent administrative measures around the foreign exchange market have eased pressure on the Naira, resulting in relative stability in all segments of the foreign exchange market. The committee was concerned about the creeping headline inflation since January 2015, but noted that the causal factors were largely transient and outside the purview of monetary policy. Furthermore, the significant rising trend in credit to government was regarded as potential headwinds to growth, with negative spillovers to the already elevated lending rates, credit to the private sector, and aggregate domestic investments, including inflationary pressures. The committee expressed deep concern over the lackluster performance of the external sector arising from a number of significant global shocks. First, the prospects of monetary policy normalization in the United States, with attendant increase in global interest rates and accentuating capital flow reversal, which could further exacerbate tightness in global financial conditions and create further pressure on the naira. Second, the continued growth in crude oil supplies amidst softening prices, anchored by sluggish global output expansion, could further threaten foreign exchange earnings and accretion to external reserves over a much longer time. A near-term rally in oil price is further undermined by the diminishing market power of the Organization of the Petroleum Exporting Countries, OPEC. Third, the anemic recovery in the euro area and Japan and tepid growth conditions in China constituted an additional drag on crude oil export prospects. Consequently, the decline in trade balance, which commenced in the second half of 2014, could persist over a much longer period, with further implications for public revenues and external reserves. In the light of these developments, the committee stressed the need for proactive measures to protect the reserve buffer, to safeguard the value of the domestic currency, and engender overall stability of the banking system. It was, however, noted that monetary policy is gradually approaching the limits of tightening and would therefore require complementary fiscal and structural policies. Furthermore, the committee considered that the current discriminatory CRR on public and private sector deposits has not only constrained the policy space, but could inspire moral hazards by private market participants. Consequently, it was recognized that while additional tightening measures may not be appropriate for now to avoid overheating the economy, the harmonization of the CRR was imperative in order to curb abuses and improve the efficacy of monetary policy. The committee's decision. In view of these developments, the committee decided by a unanimous vote to retain the current tight stance of monetary policy. One member voted to increase the CRR on private sector deposits from 20 to 25% and retain CRR on public sector deposits at 75%, while another member voted to retain CRR on private sector deposits at 20% and increase CRR on public sector deposits from 75 to 100%. 9 members voted to harmonize the public and private sector CRR at 31%. 2 members voted to remunerate a portion of the CRR. All members voted to retain all other decisions taken at the last meeting of the Monetary Policy Committee while improving the implementation of the CRR regime. Consequently, the MPC voted to 1. Retain the NPR at 13% with a corridor of plus or minus 200 basis points around the midpoint. 2. Retain the liquidity ratio at 30%. And 3. Harmonize the CRR on public and private sector deposits at 31%. Thank you all for listening.
Distinguished ladies and gentlemen, you've listened to the presentation of the communique by the governor. I want to appeal that as it is our tradition here, all comments and questions should be limited to